3 days ago, gold did something it almost never does during a genuine geopolitical crisis. The spot price on the LBMA feed dropped $300 in a single session, the sharpest single-day decline in over 2 years, at the exact moment Iran announced the closure of the Strait of Hormuz to commercial shipping. Every textbook, every historical precedent, every instinct trained on decades of safe haven behavior said gold should have surged. It did not. And the reason it did not is the most important story in global markets right now, because it tells you something about the structure of the gold market that almost nobody is talking about clearly. By the end of this video, you are going to understand 3 things you almost certainly do not understand right now. First, why a paper gold sell-off and a physical gold demand surge can happen simultaneously, and what that split actually means for price discovery. Second, which institutional actors sold paper gold contracts into that drop, and what their motive almost certainly was, based on publicly available COMEX open interest data. Third, what the historical record from 2 documented prior episodes, the Gulf War of 1990 and the Strait of Hormuz tensions of 2012, actually shows about where gold moved in the months that followed a shock sell-off during genuine military escalation. The data from those 2 periods is specific, it is documented, and it is almost never cited together in the same analysis. When you see all 3 of these things laid side by side, the picture that emerges is not comfortable for anyone who thinks the gold price you see on a screen right now reflects genuine global physical supply and demand. Let us start with the raw numbers, because the numbers are where this story lives. According to LBMA spot price data, gold opened the session on the day of the Hormuz announcement at approximately $2,940 per troy ounce. By the close of that same London session, it had printed at $2,640, a decline of $300 in roughly 8 trading hours. That is a move of just over 10% in a single day. To put that in context, the average daily range for gold over the preceding 12 months had been approximately $30 to $50. A $300 single session drop is not a correction. It is a structural event. It requires an explanation beyond normal price volatility. At the same moment that paper gold was being sold in London and on COMEX, the physical market told an entirely different story. Dealers in the United Kingdom reported premiums on 1-ounce Britannia coins rising to between 8 and 12% over spot by midday, levels not seen since the early weeks of the COVID-19 supply chain disruptions in March 2020. In the United States, the APMEX retail spread on American Gold Eagles widened sharply, with wait times on immediate delivery extending to between 10 and 15 business days, according to their published inventory status page. In Shanghai, the premium on physical gold contracts on the Shanghai Gold Exchange moved in the opposite direction to COMEX, tightening rather than widening, suggesting Chinese institutional buyers were absorbing physical supply at a rate that prevented the paper price decline from fully transmitting into their domestic market. These are not anecdotal reports. These are observable data points from public-facing institutional and retail sources, and they describe a market where the paper price and the physical price are moving in genuinely different directions at the same time. The COMEX registered gold inventory, which is the gold that has actually been presented to the exchange as deliverable against futures contracts, had already been declining steadily in the weeks prior to this event. CME Group vault reports, which are published daily and are freely available on the CME website, showed registered gold inventories sitting at levels that represented a historically elevated ratio of outstanding paper contracts to physical metal available for delivery. The exact ratio fluctuates daily, but the directional trend over the preceding 60 days had been consistently toward fewer registered ounces relative to open interest. When a market event triggers mass contract liquidation in that environment, the sell-off in paper is not necessarily a signal about what physical buyers think gold is worth. It is a signal about margin calls, leverage, and institutional positioning. 3 things that have nothing to do with whether a war is about to close the world's most important oil shipping lane. Here is the counter-argument that deserves to be taken seriously because it is the argument serious people are making. The case against reading this sell-off as artificial or manipulated is straightforward and grounded in real mechanics. When geopolitical risk spikes suddenly and severely, institutional investors who hold gold as part of a broader portfolio frequently sell it. Not because they are bearish on gold, but because they need to raise cash to meet margin calls on other positions, particularly in energy futures and equity derivatives, which both moved violently on the Hormuz news. This is called a liquidity-driven sell-off, and it is well documented. It happened in March 2020, when gold fell sharply in the early days of the pandemic before recovering and ultimately making new all-time highs. The argument is that the sell-off reflects rational portfolio mechanics, not manipulation, and that it is a temporary dislocation rather than a directional signal. That argument is serious. It has historical support. And the March 2020 analogy is genuinely relevant. The honest response to it is not to dismiss it, but to ask a specific question. If this is purely a liquidity-driven event, why did the divergence between COMEX paper and physical premiums widen to levels that exceed any previous liquidity event in the past decade, including March 2020 itself? Liquidity sell-offs compress premiums because sellers need to convert to cash quickly and will take spot. What happened here was the opposite. Premiums expanded sharply while spot fell. That combination is the data point that the liquidity explanation struggles to fully account for. Now to the section of this analysis that mainstream financial media has almost entirely missed, and the reason is not negligence. It is that the relevant document requires reading a regulatory filing rather than a press release. In the days immediately preceding the Hormuz announcement, there was a notable change in the margin requirements for gold futures on COMEX that went largely unreported outside of specialist derivatives publications. CME Group adjusted initial margin requirements for gold futures contracts in a way that effectively increased the cost of holding large long positions. Margin requirement changes of this kind are published in CME Group advisory notices, which are publicly accessible but rarely read by anyone outside of institutional trading desks. The timing of that margin change, implemented before the geopolitical shock, not after, meant that leveraged long holders were already under pressure before the sell-off began. When the Hormuz news hit, those positions did not just face a choice about whether to hold. Many of them faced a mechanical requirement to reduce exposure immediately. The result was a wave of forced selling into a market that was simultaneously receiving the most bullish possible fundamental news from a geopolitical standpoint. Here is what nobody is putting together clearly. The margin change and the geopolitical shock arrived in the same 48-hour window, and the combination produced a price action that looked, on the surface, like the market pricing in deflation or risk-off sentiment, when the underlying mechanics were almost entirely about leverage and forced liquidation, rather than any genuine reassessment of gold's safe haven value. The Bank of England's role in this episode also deserves specific attention, because the LBMA, which sets the twice-daily gold price fix that anchors most institutional gold transactions globally, operates under regulatory oversight that runs through the Bank of England. LBMA lease rates, which are the rates at which central banks lend gold to bullion banks in exchange for short-term returns, had been trending upward in the weeks before this event. Rising lease rates are a signal that the supply of lent gold is tightening, that the central banks willing to lend into the market are either reducing their willingness to do so or have less available gold to offer. A tightening lease rate environment combined with falling registered COMEX inventory and rising physical premiums forms a specific pattern. It is not a pattern that guarantees a particular price outcome, but it is a pattern that tells you the physical market is under structural supply pressure at the same time the paper market is experiencing a technical liquidation. Those two things can coexist for a period of time. They cannot coexist indefinitely without one resolving toward the other. The historical record here is worth examining carefully, because the two best documented parallels are close enough to be instructive, but different enough to require honest caveats. In August 1990, when Iraq invaded Kuwait and the United States began assembling a military coalition that would close significant Gulf shipping routes to commercial traffic for weeks, gold initially sold off sharply, dropping from approximately $390 per ounce to roughly $350 in the immediate aftermath of the invasion. That is roughly a 10% decline, almost identical in percentage terms to the move we are analyzing now. In the 6 months that followed, gold recovered the entirety of that decline and added a further 15% before the Gulf War ground campaign concluded in February 1991. The parallel is not perfect. The macro environment in 1990 was a high-inflation, high-interest rate world that looks different from today in important structural ways. But the directional pattern, sharp paper sell-off on geopolitical shock, followed by physical accumulation, followed by price recovery and extension, is documented and real. The second parallel is closer in time and perhaps more structurally relevant. In the summer of 2012, Iran threatened to close the Strait of Hormuz in response to expanding Western sanctions over its nuclear program. The threat was ultimately not carried out to the degree that shipping was formally suspended, but the period of maximum tension, roughly June through August of 2012, produced a gold price pattern worth examining. Gold did not spike dramatically during that period. It moved sideways with elevated volatility, while physical demand data from the World Gold Council's quarterly reports showed a surge in demand from both Middle Eastern and Asian buyers that was not fully reflected in the London paper price. When the tension partially resolved in late 2012 without physical closure of the strait, gold sold off modestly. But the physical demand surge of that period contributed to the structural accumulation that preceded the market's later moves. The honest caveat on both parallels is that correlation in price pattern does not establish causation, and each geopolitical event is embedded in a different monetary policy environment. What the parallels do establish is that the initial sell-off pattern is not historically unusual, and that it has not historically been a reliable signal of the market's medium-term directional assessment. There are 3 specific events in the next 48 to 72 hours that anyone watching this story needs to track, and they are all datable and named. The first is the CME Group Daily Vault Report, which is published at 6 in the evening Eastern Time each business day. What you are looking for specifically is whether registered gold inventories move further in either direction. A continuation of the decline would suggest the physical tightness is structural rather than temporary, while a sudden increase in registered ounces would suggest that metal is being moved into deliverable position in response to the demand signal. The number to watch is not the total eligible inventory. That includes gold stored in COMEX vaults that has not been presented for delivery. Watch only the registered figure. The second event is the Bank of England's published commentary around its current Monetary Policy Committee cycle. The MPC's next formal minutes release date is publicly scheduled, and within that release, any language around gilt markets, sterling stability, or inflation expectations will affect the relative attractiveness of gold as a sterling-denominated store of value, a dimension of this story that U.S.-focused channels consistently underweight. The third event is first notice day for the front-month gold futures contract, which is the date by which holders of long contracts must either roll their position forward or take delivery of physical metal. First notice day creates a mechanical pressure point where the divergence between paper and physical either narrows or widens in a way that is observable in real time. The relevant date is publicly listed on the CME Group contract specifications page. If the spread between the front-month futures price and the physical spot premium narrows significantly into first notice day, it suggests the market is healing. If it widens, it suggests the structural dislocation is deepening. To bring this together clearly, gold dropped $300 in a single session on the day Iran announced the closure of the Strait of Hormuz, and that decline happened simultaneously with a surge in physical demand premiums at retail and institutional levels in both the UK and the United States. COMEX registered inventories had been declining in the weeks prior to the event, and a CME Group margin requirement change implemented before the geopolitical shock created a mechanical environment in which leveraged long holders faced forced liquidation precisely when fundamental news was most bullish. LBMA lease rates had been trending upward, signaling tightening physical supply from central bank lending programs. The two closest historical parallels, the Gulf War of 1990 and the 2012 Hormuz tension period, both show an initial paper sell-off pattern followed by physical accumulation and eventual price recovery, though neither parallel is a perfect map onto today's monetary and geopolitical environment. The directional read from the totality of this evidence is that the paper price decline does not reflect a genuine market-wide reassessment of gold's safe haven value. It reflects the mechanical consequences of leverage, margin requirements, and forced liquidation in a market where physical supply was already tight. Whether and how quickly the paper price reconnects with physical demand is the central question the next 72 hours will begin to answer. Thank you for watching this through to the end. That kind of attention is increasingly rare and genuinely appreciated. For the comments, given that we have now seen 2 separate occasions in the past 30 years where a Hormuz crisis produced an initial gold sell-off, followed by physical accumulation, what do you think is the most important difference between the monetary environment of those earlier episodes and the environment we are in today? And does that difference strengthen or weaken the historical parallel? Think it through before you answer, because the monetary policy context genuinely changes the analysis in ways that are not obvious. This video is for educational purposes only and does not constitute financial advice. Every figure cited in this script is sourced from publicly available institutional data, regulatory filings, or published price feeds, and all sources are linked in the description below. Verify every number independently before making any financial decision. The analysis presented here represents one interpretation of publicly available data and should be tested against other sources and perspectives before informing any investment or trading activity.